Hey guys, Brett Alegre-Wood here with portfolio building tips. So what I want to cover today was affordability and loan to values, because there have been lots of changes and the criteria that lenders use and are required to use. So it's not actually the lenders, it's the regulation that's affecting us. And it may be affecting you, and a lot of people aren't aware of just how it's going to affect you. So what I want to do is take you through some numbers and show you actually how that does affect you. So we'll start off the background behind this. It's all about legislation. So there was this thing from the EU called the Mortgage Credit Directive, all right? And what that basically says, and effectively, it's quite draconian in its approach to lending. And it basically says that if you're a mum and dad, an individual, we don't want to lend to you. And that's being a bit facetious, but the reality is, it's getting harder and harder, and effectively, they're placing the blame on the last crisis on you and I, not on the banks and big financial institutions and those sort of corporate structures, because really corporate structures get out of this pretty much scot-free. It's the individual investors that it's hurting, and that's been the theme really in the UK for some time now, and it's disappointing. And what it means is that you and I who are looking to build our pension and for our retirement, actually it's got a lot harder. But yet, if you're a corporation, a big corporation, then it's got a lot easier, okay? Maybe not a lot easier, but it certainly hasn't affected you in the same way. So that's disappointing, it really is disappointing. But anyway, come back to the subject, because I can rant on all day about that. Basically, the government has decided that this was too draconian. We'll implement our own national framework. And what they've said is, right, Bank of England, you take control of the Prudential Regulatory Authority, the PRA, and implement this. So that's what they've done, and they've come up with this consumer buy-to-let. So effectively, it's regulation governing how they can give out and the mortgages that they can give out to individual buyers like us on a buy-to-let basis, okay? So that's the background, that's what's happened. Now, interestingly, this is better than this. So if that's some good news, yeah, not really. But anyway, so that's the first point. Number two, second point, is this. The old criteria used to be one of two things, and it changed with lenders, and a lot of this changes with lenders, okay? And it will change over time as well. So it's not set in stone. What is set in stone is the regulation or the application of that within reason, okay? There is still some discretion for lenders. All right, so we used to say 100% coverage, okay? In other words, the rent must cover the mortgage payment by 100% at 6% interest rate, okay? That used to be a standard criteria, or 125% coverage at pay rate, which might have been 4.5%, whatever you were paying, okay? That was a sort of, the commonly held rule of thumb, if you like. That's pretty much out the door now, okay? And we'll look at the numbers in a sec, but effectively the new criteria is 125% at 5.5, and really it's moving to 145% at 5.5. Okay, so I guess it's good news. It's come down from 5.5, but it's still, that's quite high. And this is applied regardless. You can be paying 1% interest rate right now. They still have to apply 5.5%. Okay, so that's how that applies. And look, it depends on the lender's criteria. It always depends on the lender's criteria. So what does it mean? It means you either need to get higher rents to get the same lending, or you've got to borrow less. All right. So that's really the essence of what's happening with this particular part of the legislation. There's other stuff going on that will also add on to this. Okay, so let's look at some numbers. So number one is 100K buy-to-let. So if you've got a £100,000 property and you want to get 60% loan to value or a 60K mortgage, all right? So 60K at 5.5%, okay, is $247 per month. But then you have to multiply it by, in this case, 1.45. So 275 from here by 1.45 equals 400 rent. So your rent has to be 400 on that property of 100,000 in order for you to get the £60,000 mortgage. Interestingly, if you want to get a 70% or a £70,000 mortgage on the 100,000, it goes from 400 to 465. So the rent must be 465. 80%, 531. Now, this is the stark difference between the old and the new. The old was 100% at 6% or 300. So that's a big jump there at 60%. Yeah? It's a massive jump. It's almost double the rental requirements, yeah, on that versus at 80%. All right, and we used to get 80% lending based on this all the time. So it's quite a considerable jump. And again, You either need to increase the rents, which if you're not increasing your rents, if you're not totally committed and you've got your agent absolutely committed to that, then you're a bloody idiot. You need to take that on because the rents have to go up. We have to push the rents up. Unfortunately, we as one individual don't control the market, all right? So it's going to be very hard to just push the rents up willy-nilly. The market needs to drive the rents up, all right? But you can do everything you can by saying, oh, it's a good tenant, I won't put the rents up. No, put the rents up, yeah? Make them pay the realistic market rent, all right? And the other side is borrow less, all right? Now, let's have a look. So this legislation is one side of it. I haven't even got to the other side of it, which is the debt to income restrictions. And in particular, when you get 4 or more properties, that's when it really starts to hit you, okay? So if you're building a portfolio, this stuff and understanding this and having professionals, a team around you is absolutely essential. Okay, so number 4, if you bought pre the changes, so in other words, you bought off plan, pre the changes, thinking you're going to get 75% based on the old criteria, that may not be the case anymore. So you need to sit down and do the calculations and work it out. You may have to, because obviously the loan to value potentially will drop, okay? Can you afford the increased deposit? And if you can't, then you need to take action early, okay? It's not a case of trying to blame someone who sold you the property or, blame the mortgage company or blame whoever. The reality is this is outside any individual's control. It has been, a massive push from a governmental level. As an individual, we don't have any control over this, all right? So, but you've got to take action because if you're completing in the next 6 months, 12 months, you've got to apply for a mortgage, or in fact, even currently, yeah, it is going to affect you. And it may mean that you've got to put an extra 5 or 10 or 20, whatever it is, % into as a deposit, okay? And if you don't have that money, then it might be worth considering flipping. Okay guys, hopefully that gives you a really quick understanding of the changes and the effect on effectively your deposits and the amount you can borrow, all right? Have a great day, live with passion.